battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. For the past 43 long years, it's been our mission to deliver both clarity and confidence to help secure your financial future. It's episode 149. Hard to believe. We are rolling right through. It is May as we are recording this. Can't believe it. It is coming quickly to our mid-year outlook window. In a few weeks, we will be doing the mid-year outlook show. Thank you for being here. Thank you so much for attending the past couple events that we had in Oak Brook, the Wealth Insights Forum at Gibson's. Thank you for being there a few weeks ago. Thanks for being in Houston with us. So nice to see you. I can't tell you enough how special it is that you come out to those, that you see us. We love seeing our people in person. It's just such a difference to be with you in person. It's so fun. Thank you for being there. This week's episode, welcome to the jungle. If you're listening on YouTube, Spotify, Apple, go ahead and subscribe, share it with your friends and family, get the clarity and confidence out to them, because we are in the midst of a correction. We're going to have more of a correction, I believe. Could be wrong, but I think we're going to have more of a correction before we go back to record all-time highs. And during these corrections, you need to make sure that people are staying on their plan that you care about, friends and family. Get them the show, subscribe. It helps us get it to a bigger and bigger audience. Thank you for being with us. Welcome to the jungle. Guns N' Roses. We got fun and games. We got everything you want. Honey, we know the names. Welcome to the jungle. We take it day by day. If you want it, you're going to bleed, but that's the price you pay. Here we are. We are in the jungle in the stock market. I called it the wilderness for a while. The wilderness, a little bit different metaphor and analogy. The Israelites wandering around for 40 years before they could get to the promised land. I do think we're out of the wilderness years. I do think we have more clarity on where the Fed's going to go. You may think, Nick, there's no way we have clarity on the Fed. I think the clarity has always been for us higher for longer. And so people who said that there were cuts coming later in 2024 or early in 2024, we said, be careful with that idea. We may be in this wilderness zone before we get clarity from the Fed. And here we are. So the wilderness, I think, is coming to an end. I think we're in a new zone. I'm going to call it the jungle. Welcome to the jungle. And what that means is the jungle, well, you can move forward. You can see gains. You can get through things. You can take out your machete and chop down the trees in front of you and find a path forward. But it's still the jungle nonetheless. We've got monkeys swinging. We've got baboons. We have things going on that are a little scary at times. There are traps all around. You have to watch out for things, but we are going to get through the jungle. This is the time of the market we're in before we get out and we do get to the promised land, which is a record all-time high in the stock market. Arguably, we did have the promised land very briefly in March, all-time record high, 5250 on the S&P, 38,000 on the Dow. Really enjoyable to see those numbers on our statements, and we're handing some of that back just as we predicted. We try to give you tomorrow's news today. How do we do that? Well, we just look at the math of the stock market. And so that's what we try to do. We try to give you the data, not narrative. We try to give you the numbers, the math, statistics, everything that's going on behind the scenes of why you should either invest or just be aware of the fact that we could have a downturn. Everything with the market is based on a simple equation, earnings times price. And so whatever companies are going to make, S&P 500, the best 500 companies on the globe, we focus on the top 50 in your portfolio if you're a client of ours. And the top 50 in particular are just hard to replicate. I mean, these are the best business models, the best balance sheets, the most cash in most cases available, the lowest amounts of debt, and growing earnings in most cases, growing revenues, and very good earnings per share metrics. We're getting buybacks, we're getting dividends. And so that's what you're investing in the market. Whatever those companies make in profit, then we multiply that by some sort of price to earnings multiple, and that's how you end up with the S&P. So the S&P at 5,000 points today, roughly, I think where it is, I just looked at it a few minutes ago, it might have changed, but let's say 5,000 points. Let's say next year we're going to get $250 or $260 in earnings. Right now, today, we trade around a 20 forward price to earnings multiple, 19 to 20. Now, depending on those two levers that you can pull, and I've given you this example time and time again, you can see stocks go up in the short term, down in the short term, but as long as the fundamentals of the market are pretty sound, as long as we're seeing earnings growth across the different sectors, I think the doom and gloom calls that earnings are going to fall apart, that companies are going to fall apart here, I think is largely overdone. And you have to remember the math of the market. Not every company in the S&P is the same company. They're in different sectors, different industries. And so while one sector might be doing poorly, another sector may be coming in and doing better than it did a couple years ago. And we're seeing this, it's called sector rotation in the market. We're seeing certain sectors produce earnings that we've been waiting for a few years. The energy sector in particular is producing phenomenal cash flows. We're seeing the industrial sector hold its own pretty well here. We're seeing financials actually come back in a surprising way. Not surprising to you. You've been watching our show. We've been saying, we're going to see some of this broadening out of earnings. And that's a positive sign long term for the markets. It's a bullish sign when you start seeing things widen out. It's not just 10 companies driving the market. Arguably, today, those 10 companies are actually underperforming. Some of them are underperforming this year, and we're seeing energy stocks take the lead. We're seeing financials take the lead. We're seeing industrials take the lead. So that sector rotation is positive. We're getting earnings from these different companies. ExxonMobil is producing record cash flows. Not an investment advice, not telling you to go buy or sell. Just giving you an example, we're seeing EOG Resources produce record cash flows. VLO, Valero is producing great cash flows and earnings. Some of the other energy companies are doing pretty well. And then we're also seeing some of the companies like Microsoft still lead the charge, producing unbelievable cash flows, unbelievable revenues. You're seeing the AI thing keep going here. AI is not all overblown. There are pockets of it that are turning into a bubble, and I think you have to be careful. So I'm going to summarize right now what I'm going to, again, recap at the end of the show, which is just own quality. So I've said we could have a recession here, very possible. It's not going to be a long-lived one. It's not going to be massive. That's at least my opinion. I don't think we're going to fall completely apart here. I don't think we're looking at an 08, 09 style collapse. I just think that things are hot, and we're going to have to give a little bit back of the gains the past couple years. That's a normal cycle. And so what are we watching primarily? Well, we're watching the Fed. Why? And then that's the other side of the equation. You can have great earnings, great balance sheets, great revenues. That's all fundamental. Then we have the variability of where's the Fed going with rates? Because if rates stay elevated for a long time, lower quality companies can get decimated and go bankrupt. The small business owner employs a lot of the economy. And so that's why you have to be so careful with small business, with mid caps, with risky or leveraged other companies that have not really paid down their debt, that have taken on a lot of high interest loans to be able to finance their projects. And when you have a high cost to capital, it starts to make the average project on a corporate level not worth doing, or it makes it very hard to get over that hurdle rate, is what it's called. Now, if you're doing all of your growth and all of your expansion with cash, you can easily get over the cost of capital. And if cost of capital, like it is today, is 5.5%, you're not using debt to do it, you're just financing with cash, you could probably do pretty fine. And that's why I say high quality, large cap companies should do well here through the entire cycle, even if we go into a downturn. It's not like they're insulated. It's not like Microsoft or Apple or Amazon or something like that is insulated from a recession. It just should perform based on history. It should perform better through a cycle than a company that's got a lot of debt. Okay. And I just was at a due diligence presentation. We do our annual due diligence meetings. We're already well into this process. I just had one today. I had one yesterday. And we're looking at this thing called private credit. And not that we're going to buy it for clients, but just looking at it as an opportunity as far as, are there bubbles forming in the private markets? Are there bubbles forming for small cap companies? Because that's who private credit typically lends to. And I do think there are some issues. I think what's happening here is spreads on that debt. You got to remember, 2 years ago, the 2-year treasury was like 0.1% in interest is what it paid. Today it's 5%. Okay. And then the spread that they put on a higher yield loan or a riskier loan, the profit that you take for making a risky loan, has gone from 500 basis points or 5% to now 8%. So spreads have widened pretty dramatically here. And what this all means to small businesses is that they're typically taking out loans at 12, 13, 14, sometimes even 15% interest. That's a big problem. And if you've gone from financing your debt at 5% to now 10%, just easy math here, that's 5% on that that loan that you can no longer reinvest into your company. You may eventually have to do layoffs, and that's what the Fed's watching. Remember, interest rates are on a lag, and so that's why the Fed, when money printing was going through the roof in 2020 and 2021, should have raised rates sooner. They should have tried to slow down a lot of the excess that we're dealing with today. They didn't do it because, remember, interest rates and monetary policy functions on a lag. You don't get, if you raise rates to 5%, it could take a year before you see that actually trickle into the economy. Well, the other problem on the other side of things is that it also can take a year for rate hikes to really go into effect, and then rate cuts to work their way through, because companies are run by people, and you have to understand this. If you can understand one or two things from the show today, I would say one of them should be that companies are run by people, and people are subject to all the same concerns and issues that you and I are subject to. Just like we get nervous, just like we might get scared or tighten our belts a little bit or get a little bit more cautious with our personal spending, companies do the same thing. And so it's almost a self-fulfilling prophecy when you start seeing the Fed get hawkish and they get very tight with monetary policy and they tell you, hey, we're trying to kill growth. Okay. What do companies do? What do management teams do? They sit around the boardrooms and they say, hey, we know there's risk out there. We don't want to be the next Blockbuster, and we don't want to be the next Sears to go under. So we've got to prepare for a rainy day. And I think some of the preparation at the large cap companies has been very good. Some of it has gone too far. And when it goes too far, what happens is it slows down growth. Then companies lay off. You saw Tesla, Elon Musk, I think they processed like 14,000 layoffs or something massive like that. I might have gotten that number just slightly wrong, but it was a massive amount of layoffs. You saw this at Facebook the past couple of years. They went big into the metaverse. You're like, wait a second, nobody really wants to be in the metaverse, so we're going to have to scale back. What do? They do layoffs. Their earnings go way up, and the stock's back to record all-time highs. That's the cycle. That's the normal boom and bust cycle. And if you don't have an experienced management team, what happens is these boom and bust cycles are much more dramatic. You expand way too fast, and then on the downside, you have to cut, and then you'll get back to normal. If you have a strong balance sheet, you've got cash. It's not like you go under. It's not like you go out of business, but you just see bigger swings in your stock price. And so that's why I've said, again, own quality, because quality can really protect you, I think, through the entire cycle. So how do cycles work? And this is where I want to just help you kind of think through how these processes in the economy see themselves out. And I think the jungle analogy is really important, because the jungle is very confusing. It's not the wilderness. When you're in the wilderness, you kind of know, hey, we're in the wilderness for a while. We're eating manna from heaven, and we're just hoping we can make it to the promised land, and we don't end up like Moses. Remember, Moses didn't even get to go into the promised land because he didn't stay on his plan. Okay. So remember, you got to stay on your plan. You don't want to be like Moses. But in the jungle, it's a little different. You're sort of moving along here. Things are not horrible, but there are pitfalls. I mean, there are booby traps along the way. There are things you have to watch out for. And that's what I'm pointing out, is the fact that through these cycles, I just want to help you understand what part of the cycle we're in, because it can get confusing. When you're going through an economic expansion and you're coming out of recession, that's the first piece of the cycle. Think about maybe 08 and 09, when everybody was worried, everybody was doom and gloom, people had lost their houses, there were horrible things happening in the economy. All of a sudden, we fixed mark-to-market accounting, which Brian Westbury at First Trust Portfolios pointed out before anyone else, and said, hey, be bullish because stocks are cheap. Okay, well, we bought stocks for our clients. You saw us buying during 08 and 09. Why? Because stocks were on sale. And then suddenly sentiment kind of shifts. All of a sudden, people say, you know what? Things aren't quite as bad as we thought. Things are going to get better. The world's not coming to an end. And people shift their mindset. You see that shift in consumer sentiment, where people now are saying, all right, we're going to buy houses again. We're going to start businesses. We're going to start spending money. We're going to do the things that we used to do. We might dip our toe in the water because we just had the bad event happen a couple of years ago, or the black swan is what it's called. And now we're going to try and get back to normal. And so then you see that uptick happen. And that's what happened in 2011. And then all of a sudden you start getting into expansion mode. And expansion mode's fun because you get to spend money. People are making more. Their wages are going up. Businesses are being formed. Capital is being invested. And during the expansionary cycle, remember, human nature eventually kicks in at a certain point, and then people bid up the prices of assets, sometimes to the point where they become a bubble or they become too hot. And not every expansionary cycle ends in a bubble and a pop. You saw it in the 90s, you saw it in 08 and 09, but it doesn't always happen. Sometimes what happens is there's just sort of a slowdown that happens. There's a little bit of a pullback, a market reckoning, maybe a correction or something like that. That's where we're, I think, headed right now. And again, it's not the end of the world. It's not like the world comes crashing down. It's just a slowdown. You can't grow forever into perpetuity. You have to take a break once in a while. And so that's what we're, I think, in today. We've had a phenomenal expansionary cycle. We have seen just incredible growth. I will say we had a technical recession in 2022. And so that's why I say, because we had a technical recession, the government never called it that. Nobody ever said, hey, sorry to say, White House, we had a recession, and I know you're going into the midterm, so we're not going to say anything. We're not going to try and make you look bad, but we had a recession. Nobody said it except for us. That's 2022. We had 2 consecutive quarters of declining real GDP. That's why I'm saying we could be a while before we end up in a next recession, because you don't get a recession typically every year or every other year. It takes a little bit to kind of work its way through the system. I just think we're kind of getting to that point where inflation has run its course. Companies are slowing down. People are tightening their belts. And if you haven't noticed this, you can start to see it in the company earnings reports. And we read them. We listen to the quarterly calls. I was listening to Starbucks the other day. I listened to McDonald's. I listened to some of the other consumer stocks. And the sentiment you're getting from CEOs is like, hey, things aren't as good as they were last year. It's not completely falling apart, but we are seeing a pullback of 2 to 3, maybe 5%. When you start seeing a little bit of a pullback, you have to understand how public company CEOs operate. Again, companies are run by people. People make human nature decisions, okay? And so companies like Starbucks eventually may say, okay, we had a 2% or a 5% decline in sales. Let's hope it doesn't become a 10% decline. It might just be 4 or 5. But we're going to start to trim our expenses relative to how much of a decline we've had in revenue, because we can't just take a lower profit margin. We're a publicly traded company. We got to be operating in shareholder best interest. We have to be delivering profits and growing those profits over time, increasing shareholder value. And they may say, all right, we're going to lay off people. That's the easiest expense in a services-based economy. It's any company's biggest expense. We're going to trim back on our budget. We're going to close a few stores. That's the last resort typically, because a store has a long-term lease, so it's very hard to completely shut down a store. But they're going to cut back on their expenses. And again, because the biggest expense is labor, the Fed and us, quite frankly, are watching labor like a hawk. You are not going to get rate cuts. And I'm willing to say this on this show. It's a recorded show. I'm willing to say this. Could be wrong, but I will just say I don't think you're going to get cuts until something bad happens with the labor market. The Fed is not going to cut as a reward. They're not going to reward markets and say, hey, here's a big pat on the back because we had a 5% decline in the stock market. The Fed is going to wait till something breaks. And how do I know that? Because that's what they've done every single time. The only time they haven't ever done that in human history, or in U.S. history, I should say, is in the 70s. And during the 70s, you had Arthur Burns, who let inflation run amok. It was a complete debacle, a complete disaster. And then Paul Volcker had to come in and finish the work that Arthur Burns couldn't do. And that was to hike rates to 19% at one point. So that's what has to happen. The Fed is going to have to break something. Unfortunately, this is just how the U.S. economy functions now. I'm not saying it's good. It's actually a bad thing that we deal with this. And the Fed should be disbanded, in my opinion. I don't think we should have a Federal Reserve. It's a component of Marxism. Richard Nixon, again, kicked us off the gold standard in 1971, which is just sad. I mean, it's just awful that we did that. We abandoned common sense. But here we are. This is the reality of what we're dealing with. And so that's what I'm saying. Something bad is eventually going to happen, but it could take a year. It could take 2 years. It could take 3 years. And markets are going to bottom before something bad happens, before we have a mass layoff event, before we have something break in the housing market, before something really occurs. The market's already going to be down 10, 15, 20%. And you trying to time that and get in and get out and trying to figure out when's the best time to sell my stocks, go to cash, and then buy back into stocks when things bottom out. There's no way you're going to figure that out. It doesn't work that way, because anything that you think is going to happen, guess what? You're not trying to offend you, but You're not smarter than anybody else out there. You're not smarter than anybody on Wall Street. Nobody on Wall Street is smarter than Main Street. Everybody's operating with the same data. Okay. Everybody's got the same set of facts and information nowadays. We live in an information economy. You can pull data yourself. You can get your hands on it and you can say, hey, I think a slowdown's coming. Well, guess what? There's already half the market to think that that's going to happen. And then you've already got half the market that thinks things are going to do fine. That's what makes a market. You got buyers and sellers. You got bulls and bears. That's what you need to have a functioning stock market. So you trying to take a side on this and figure this out is a losing strategy. I mean, there's no way that you are going to be able to beat and time the market consistently over the long run. You may get out at the right time, but then you got to figure out when to get back in. And while you're trying to figure out when to get back in, the markets will make brand new all-time highs and it'll be too late. And you'll be like, oh man, I should have listened to Nick and just held on. I should have kept my stocks. I shouldn't have abandoned ship. And I'm going to say, told you so. Okay. So that's what I'm trying to tell you is own quality through the whole cycle because you just don't want to get wiped out on a specific company. It's not that McDonald's is not going to be susceptible to a recession. McDonald's will be susceptible. They will go down. They will have layoffs. They'll have all the problems that all the other companies are going to have. But they've got a good balance sheet. And I believe, not investment advice, that they will make it through and live to see the other side of the recession. So that's really what you're trying to do. That's how these cycles work. They start with people thinking that things can never get better, that things are always going to be horrible, and then things do get better, and then people think things can never get bad, and they're always going to be great, and then things do get worse, and then people are surprised. That's just human nature. So the part of the cycle we're in today is slightly in the middle. That's the jungle aspect. We're kind of in the middle of these two sentiment shifts. Some people think the world's coming to an end. Some people think that things are going to kind of plow forward here. And I'm more in the middle of the road here. I think that stocks today are fairly valued. I don't think they're overvalued when they were at 5250 or if, the projections that stocks would be 6,000 by year end. I don't think that's going to happen. I think that's way too bullish here. But I'm also not bearish. I'm not saying that the world's coming to an end. I'm not saying that stocks are going to drop 20%. I really doubt that's going to happen. I just think we're going to see maybe some bouncing around here, 4,900, 4,700 on the S&P, back up to 52, 5,300. And I do think that the stock market's going to recover its losses and make new highs by year end. So stay bullish, stay on your plan. Again, I go back to that basic math equation that assuming rates stay constant here, and this is the one thing I will add to this, assuming rates stay constant and we don't see rate hikes, and I know you're thinking, Nick, that's crazy. There's no way we see hikes. It's not so crazy. It's in the cards, okay? I do think it's not a high probability, but it's a possibility. We saw this in the 70s, that rates actually had to go up after going down, okay? So this is something that can happen, and assuming that it doesn't happen, I do think that stocks will chug along. If rates go up for some reason, if rates go up 1% or 2%, and I'm talking on the overnight lending rate, the rate that the Fed controls, that's a huge problem. I mean, that's when you do see stocks drop 20, 30%. I just think it's a very low probability of happening. It's a possibility, not a high probability. I think more likely we're going to see earnings do fine. I think when we fast forward 2 to 3 years from now, earnings on the S&P are going to be close to $300. I think the S&P's price to earnings ratio will be close to 20, and that's where you get to 6,000 points. I just don't think it's going to happen tomorrow. I think we're going to get to 6,000. It's just going to take us a few years. So my advice is just stay on your plan. You're not going to be able to panic and get in and get out and time this thing. It's just a losing strategy, especially in the jungle years. I just want to make one comment here on the monetary system because there's a lot of questions coming in. A lot of people are saying, Nick, what about gold and silver? What about doom and gloom prepping? What about building the bunker in my backyard? It just seems like with all the social unrest, with all the stuff going on, all the protests and all the horrible things, I should probably get bearish here and I should just start, hoarding guns, butter, gold, and ammunition. Okay. I'm not telling you not to do that. I'm not saying that there's stuff that doesn't concern me because there is. There are things out there that concern me about the way that social unrest is going on right now. But I just want you to take a 10,000-foot view above all of this and just realize that we have gone through social unrest before. It feels a lot different today because it's social media fueling the flames. We've got all these news outlets that just want to make money off of the advertisements and fan the flames. So I think some of that is overblown. I think some of the concern is overblown. It's not unusual compared to history. But what I will say is the way that this has always worked for 100, 200 years is the same. You have a group of people who have a lot of power and control, and they are incentivized to fund groups that cause problems, that cause riots, that cause unrest. And there's even plenty of documentation that, for example, the Soros Foundation funds a lot of the conflict out there. And their goal with this, and by the way, they fund both sides. They fund Israel, they fund Palestine, they fund. They did it in World War II. Okay, they funded both sides of pretty much every major war. And at the end of it, what happens is they come in with the solution. So that's what they want to do. They want to create conflict. They want to cause problems and then come to the rescue and say, we alone can fix the problems that we created. And that's why Ronald Reagan said, be careful with big government, because what happens in big government is government creates problems. They create issues, and then they claim that they can fix those problems. It's all run by the banking system. It's all run by big government. It's all run by money printing. And just watch out for money printing, because at the end of the day, we all want to live in a pro-human world. We all want to live in a pro-human future. And whether you're left or right, whether you're Democrat or Republican, whether you come from one side of the political aisle or another, or don't even care about politics, what we all should want is limited government. We should want government out of our lives, because the bigger government gets, the bigger the central banks get, the bigger the large companies get, it's bad for all of us, because it's the stomping out of the little guy. It's 1984, George Orwell. And that's what you have to be so careful of here. And so understand who the true enemy of the people is. It's not left or right. If you're a Democrat and you hate Republicans, the Republicans are not your enemy. If you're a Republican and you just detest the Democrats, be careful. The Democrats are not your enemy. The enemy of the people is big government and a big Fed and a massive monetary system, because over time what happens is we deflate people's money. The biggest hidden tax of all time is inflation, and it always hurts the lowest people, the poorer people, the hardest. And I don't know if it's engineered at a high level. I don't know if this is on purpose. It sure seems like it sometimes, but this is where we're at today. We're in a point where there's some risk out there. And so that's why I've told you, be smart about your own personal situation. Make sure that you're protecting your balance sheet. Make sure you've got a rainy day fund. Make sure that you've got stability in your job. And if you don't, maybe look for something that's going to give you some stability. Make sure that you're at a point where you're not taking on leverage. You're not spending on unnecessary items. Make sure you're deferring purchases if you can, and saving for a rainy day. Because if you don't do that, that's who gets wiped out when these things ultimately culminate. And when the chickens come home to roost, you don't want to be left holding the bag and be one of the people that gets knocked out. So that's my advice to you, is just be aware of how the system really works. It's big spending and big hidden, maybe sometimes convoluted sources that are funding these conflicts, and then they're eventually going to come in and try and offer the solution. And that's a scary thing. That's not a good thing. So be aware of who the enemy is. It's not your neighbor. It's not somebody who looks different than you. It's not somebody on the other political side of the political aisle than you. It's big government. That is the enemy of the people. What could we ultimately end up in? And this is the problem with gold. So first of all, everyone's saying gold is an inflation hedge. It's not really. It's a dollar hedge. So be careful with this. You don't always see gold spike when inflation is hot. You see gold spike when the dollar is strong. Remember that all these central banks out there own treasuries. China has tons of our treasuries on their balance sheet, and that's not a bad thing, okay? They don't own us. People have said, oh, China owns us because they have all these treasuries. No, that's not how it works. They're more indebted to us than we are to them, because they hold all these treasuries, okay? We don't hold yen like they hold treasuries. So they're indebted to us. Don't forget that. But they also are buying gold. And all these central banks across the world are buying more gold than ever before. But remember what gold is bought in. At some point in the value chain, gold is purchased in dollars. And so the reason gold is at an all-time high right now, yes, partly due to inflation, but almost all of it is due to a strong dollar. Gold is not the antidote, though, to all of our problems, because if we're on gold and everybody's got gold bars, and you're going to your neighbor and you're saying, I'm going to go to the blacksmith shop and get my horse hoofs put together like you do at Naperville Settlement here, and give them a gold bar for the horseshoes. Okay. Well, eventually gold gets mined and there's no more gold left, and the price of gold goes up anyways, which still doesn't solve your problem with currency. So what I really think, okay, and the antidote why I'm long-term optimistic, I'm long-term bullish, is people could just agree eventually to go to a barter system. Okay. If the government taxes you enough, if the government deflates your currency enough, people could say, forget this. Okay. I'm going to go to my doctor. I'm going to get a couple of doctor visits, and I'm a financial advisor, and I'm going to do I'll do financial advising for him, and he'll do my doctor visits. Okay. That's where people will go eventually. They will go to a barter system if the government pushes them enough. That's what happened during the Revolutionary War with the Boston Tea Party. And that's what this ends up in. And so all these politicians who are high and mighty and are on their high horse, or all these central bankers and all these central planners and communists and Marxists and all these people at the UN who say, oh, we're just going to have a one world government. We're going to force everybody into basically indentured servitude, and nobody's going to be, you're going to be poor and you're going to like it. You're going to own nothing. And that's going to be great and wonderful. And it's going to be a renting world forever. People aren't going to put up with it. Okay. And the way that people don't put up with it is, if pushed enough, is they go back to a barter system. And that's exactly where this will go. So I'm not doom and gloom long term. I am optimistic long term. We're going to figure it out. We're going to get back to some common sense. The pendulum will swing back. It's swung so far right now to one side. And I'm telling you, that swing back to the middle is coming. And so just be optimistic long term. We are going to be just fine. Things will work out, and the sky is not falling. Don't make investment decisions based off of some of these doom and gloom stories you see on Twitter. You can't believe everything you see. You can't just subscribe to every tweet and take it as gospel, because there's a lot of nonsense out there. There's a lot of people selling stuff. We're selling something. I'm not going to say we're not selling something, but we're selling a long-term plan. We're selling guardrails for you and your family to stay on a plan over time so that you don't blow yourself up. So my main goal, if you hire me, if you hire our team, is to just keep you going over time and pass down money for multiple generations. There's people selling something else out there, and they're selling insurance. They're selling doom and gloom stories so that they can get you to panic and buy what they're selling, which sometimes is gold, sometimes is silver, sometimes is annuities, sometimes is all these different strategies that are supposed to protect you. And in the long run, they don't. The best antidote to big government, the best antidote to inflation over time has been securities. It's been equity in companies. So that's my goal. That's my plan for you, is to stay on your plan. And if you do this and you do that, you stay on your plan over the next 5, 6, 7, 10 years, you're going to make it out alive. And so that's what you have to do in these jungle years. So welcome to the jungle, episode 149. Thanks so much for being with us. We'll be back next week for the big 150. Thank you so much. We'll see you next time.